Great, thank you for bearing with me. We'll get started now. Good afternoon. I would like to welcome you to the New America Foundation for our book event today, The Subprime Virus, Reckless Credit, Regulatory Failure, and Next Steps by Kathleen, Engel, and Patricia McCoy. Reed Kramer. I direct the asset building program here at the New America Foundation. And our work focuses on policy mechanisms to promote social development and economic security, especially in ways that help families save and build up assets over time. And housing and homeownership can and have played a significant role in this process. And yet, given the experiences, the recent experiences of the Great Recession, we really should be looking critically at this process and focusing on learning some lessons that can help inform future policy efforts. So today's discussion is really part of that process, designed to do just that. We're very pleased to have Kathleen Engel here with us, who, along with her co-author Patricia McCoy, have really produced a very timely and important book published by Oxford University Press and just out. There are books in the hall. They're available at bookstores near you. And really, it's a very impressive and timely piece. Kathleen is professor of law at Suffolk University Law School in Boston. She's also the associate dean of intellectual life at the school. And I think we actually could use some more intellectual deans here in Washington. Sounds like a nice title. Maybe we'll send you to the Hill. They could use some intellectual life over there. She's a national expert on mortgage finance and housing policy and has grounded a lot of her work in looking at dynamics at the local level, at the community. She spent a great deal of time in Cleveland, and that really comes out in the book. It's really one of the unique aspects of it. It chronicles what happened at the local level in lending practices and how that interacted and really created this global financial crisis. It was the spread of abusive lending, regulatory oversight, kind of abdication, and really this insatiable demand for mortgage-backed securities, which were sliced, diced, and sold around the world, that became this toxic brew and a recipe for disaster. It could have been stopped. There was a lot of evidence early on that lenders were being unfairly targeting certain families and really, in the long run, stripping assets away from these once stable and aspiring families. And so the failure to protect consumers is really at the root of the story. And the analysis, though, really looks forward about what we should learn, and I think that's why it's very important. We're very fortunate to have Raphael Bostic with us, who currently heads up HUD's Policy Development and Research shop. In a previous life, he's actually was a collaborator with Kathleen and Patricia, but he brings a lot of expertise to this discussion. In his current position, he's also looking forward and informing a lot of the policymaking that's coming out of HUD around housing issues, working very actively with Treasury and the White House on a wide array of housing policy and housing finance issues. And in my estimation, this is a very good thing, because when HUD's research shop is integrated with other things going on at HUD and the administration, it's a recipe for actually good policy making and good thinking. So I'm very impressed with how PD&R has kind of played a role in the administration so far, and that's under Raphael's leadership. And I'll also draw your attention to this recent white paper that Treasury and HUD released on reforming the housing finance system. He had a major hand in shaping that, and among other things, it made perfectly clear that Fannie Mae and Freddie Mac are going to be wound down, but it outlined a series of options that should be investigated about government's insurance role in the market. Which probably was a pretty good idea of not endorsing a single policy, but getting a bipartisan conversation started. What I thought made this document particularly effective was its diagnosis about what went wrong and what the principles should be to guide future action. And really, regulatory failure and the failure to protect consumers was, again, the root of the problem. If the book had been out, they could have footnoted the subprime virus in this piece. So what does it mean for housing policy? That's what we're going to talk about today. I think credit is certainly going to be less available. Savings is going to be a big part of the process. Thinking about long-term planning will be part of the process. and the importance of having access and families having choice in their housing array among housing that's near good jobs and good schools is, I think, going to be more essential than ever. So I look forward to hearing Kathleen and Raphael weigh in on this point. Quick note about Kathleen's co-author, Patricia McCoy. She previously was a law professor at the University of Connecticut, recently came to D.C. to join a startup, which is the Consumer Financial Protection Bureau, and she's assembling a team there, and she's been appointed as Assistant Director of Mortgage and Home Equity Markets, and their temporary offices are just a few buildings away, so they're right in the neighborhood. So let's have Kathleen come up and make some remarks, and then Raphael will make some, and then I'll pop back up and we'll have an extended Q&A. So help me welcome Kathleen Engel to the podium.
Thank you very much, Reed. I really appreciate the opportunity to come here and talk about the subprime virus. And it's exciting to be at the foundation. I've never been here before, although I've been a fan for a very long time. Reed asked me to talk a bit about the origins of the book and what it was we were detecting in our research on lending. In 1999, my family lived in an inner ring suburb of Cleveland, Ohio. And at that time, predatory lending was really in its infancy in the rest of the country. But in Cleveland, it was thriving. Brokers were targeting people, particularly in communities of color. As some of you know, Cleveland has some very nice inner ring suburbs that are racially diverse. And they were betting on the fact that because of the history of discrimination in the United States, that there was pent-up demand for credit and that there would be borrowers who were looking to take out mortgage loans. For people like my family that lived in a racially diverse neighborhood, mortgage brokers were constant pests. My daughter is here traveling with me, and she periodically would answer the phone, and it would be a predatory mortgage broker, and she would say, "I know you're a predatory lender," and hang up. And that wasn't because I trained her. They just got used to the calls. But they would send flyers to us. They would knock on our doors. They would call at dinner time. This was before the do not call registry. And their favorite targets were vulnerable people. And in many of the suburbs of Cleveland, there were housing ordinances that were very strong, where your house got inspected on the exterior, I think maybe every 7 or 10 years. And you always got dinged for something. It could be one shingle was loose, or it could be something much more dramatic, like you need a new roof or a new porch. So they would go and they would find the records, and it was like a miracle. The day after you got cited by the city for a housing code violation, there would be this charming broker at your door offering not only to arrange a loan for you, but to connect you with a home repair contractor. They found out they discovered women who had recently lost their husbands through the obituaries, assuming that these were good targets because maybe the women weren't so involved in the family's finances. And basically, the strategy was find people who might be vulnerable and then target them with these loans. Most of the loans during this period, we're talking the late 1990s, were made to people who had a lot of equity in their homes. They had equity either because they were senior citizens and had lived there for a long time, or they were homes that they had inherited from family members. But there were people who usually were income constrained. And the way the loans were set up is that they were really backed by the equity in the loan. They weren't affordable loans from the get-go. And then the brokers would refinance the loans over and over again until there was no equity left in the home. And with each refinance, the brokers would get more fees. So we saw this phenomenon and couldn't understand it. And other than some community groups, there was not a lot of discussion about this kind of lending activity, in part because it was very much isolated to certain parts of the country, parts of Pennsylvania, Michigan, Ohio. So the questions that we were trying to answer were how could brokers sustain these practices? How can you have a business model that's based on people eventually losing their homes? Why would lenders fund loans that ultimately were going to lead to foreclosure? And what had changed in the mortgage market to create space for this type of lending. And questions also about borrowers. Why were they agreeing to loans like this? This is during a period of time where credit was becoming more and more available. Why would they go this route as opposed to more traditional and hopefully more responsible lenders? And then there were the questions about the government. Where were the government regulators as this industry was booming? And what were the roles of the financial markets and of investors in mortgage-backed securities in terms of creating and financing this market? So for over a decade, through our research, we tried to answer these questions. This started as really as a book group. We had a book group of two people who said, the two of us said, we're going to sit around over the summer and figure out what's the law and economics of this phenomenon, and we haven't stopped since. So during the same time that predatory lending was starting to take hold in other parts of the country, it started to expand, it also started to morph from fringe lending by small companies to mainstream products marketed by the largest financial institutions in the country. And sometimes this marketing was direct, but most often it was through subsidiary organizations. So the big subprime lenders, you would recognize their names, but for many of you, you wouldn't know that actually they were owned by HSBC, Citibank, I mean, you name it. I don't want to target anybody in particular. But almost all the lenders who engaged in the really egregious lending behavior were owned by major commercial banks or investment banks. And the reason for this was what finance economists call vertical integration. Vertical integration is a way of structuring a firm so that you can streamline the process, in this case, of securitizing home mortgages. So banks wanted to have securitization factories, and to have a securitization factory, you had to generate loans to securitize. So they started to buy lenders, and if they didn't actually buy a lender, they would establish some type of a formal relationship with the lender. The other big change in the market was that the loans in the early predatory lending era were very much equity-based loans. And over time, as housing prices continued to go up, the loans were made more on the expectation of a rise in home values and also based on people's incomes. So, and at the same time, there's another phenomenon, which is that the loans became ever more complicated. That's when we started to see teaser rates and pay option loans and other terms that masked the fact that the loans were unaffordable. So we all know what happened. In 2006, the mortgage market started to crumble, at least started to tremble, and crumbling came next. And the first few chapters of the subprime virus really tell the story of what happened up through 2006. So it tells the story of the beginning of the predatory lending market and then up through the time that problems began. And we describe what was happening, as Reed said, both from a neighborhood level up through what was happening at Congress, the Federal Reserve, and Wall Street. The first line of the book is, "Hope doesn't come easy in Cleveland." And we end with where Cleveland is at now, 12 years later. Then we go on in the book to describe the crisis as it unfolded. Everybody remembers all the scary headlines in the newspapers and things like that, but we chronicle exactly what was happening, the problems that were brewing, how the government was responding to it, how the market was responding to it, what was happening around the world. And our goal in these chapters was to tell a complete story, a story that integrated policy, understandings of financial markets, some behavioral markets, and stories of real people. The book is a pretty easy read, but I have to warn you, the type is small. In many ways, what we were trying to do in the book was to answer the questions, who knew what when, and what did they do about it? And it was in this vein that we also took on the role of the federal regulators. As many of you probably know, there were states and some cities that tried to curtail abusive lending early on by passing anti-predatory lending laws. They encountered formidable obstacles, most notably lawsuits that restricted their ability to stop the abusive lending that was polluting their neighborhoods. What many people don't know is that the federal regulators had the power to stop this high-risk lending, and they chose not to exercise that power for many years. And the book goes through a lot of different examples. I'm going to highlight just a few. In 1994, Congress passed the Homeownership Equity Protection Act, and in it, they required the Federal Reserve Board to use its rule-writing authority to prohibit unfair and deceptive mortgage practices. Alan Greenspan refused to follow this congressional mandate. Equally concerning, the Fed was charged with supervising bank holding companies and their subsidiaries, including HSBC, Citibank, Countrywide, and they chose not to examine the subsidiaries until 2007, long after the cows had left the barn. In 1990, the SEC chairman, Arthur Levitt, and Alan Greenspan, and two Treasury secretaries, Robert Rubin and Larry Summers, endorsed deregulation of credit default swaps. They are the very instruments that brought down AIG, and but for the taxpayer bailout, would likely have collapsed the world economy. Not until 2006, following the Enron crisis, did the federal government begin regulating the credit rating agencies and in any meaningful way, and even then, it was very much regulation light. These rating agencies gave the good housekeeping seal of approval to dicey bonds, and the government did nothing to limit this practice. If you want more examples of the government lapses, as Reed said, the book is available at your local bookstore, and if it's not, you can request that they order multiple copies. Moving sort of fast forward to today, there's been a great deal of press about how the policies of the federal government may have spurred the financial crisis. Some people, including the dissenters to the recent report by the Financial Crisis Inquiry Commission, take the position that the federal programs that encourage lending to low and moderate income borrowers were the cause of the crisis. And they often, in these arguments, cite the Community Reinvestment Act, which grades banks on how well they meet the credit needs of their local communities. High CRA grades can be important to banks' ability to expand, for example, to acquire another bank or to become a bank holding company. And critiques of CRA claim that this law created an incentive for banks to make high-risk loans, and that then led to the financial crisis. And so one of the things I think that's important to know is that there has been extensive empirical research looking at this precise question. Did the CRA play a role in causing the financial crisis? Did it create incentives for banks to make high-risk loans? And all the empirical research has found that no, the CRA was not responsible for the financial crisis. Another argument has been that Fannie Mae and Freddie Mac, the two government-sponsored enterprises that are now in conservatorships, were the source of all evil. Fannie and Freddie, for starters, are not lenders. Their primary activity is purchasing loans from lenders that they then convert into securities. Fannie and Freddie are connected to the government because they receive certain financial privileges in exchange for meeting HUD-imposed targets for purchasing loans that were made in low and moderate income communities and to low and moderate income borrowers. It is this connection that has raised outcries that the government's affordable housing goals were the cause of the crisis. The reality is that Fannie and Freddie were at the vanguard when it came to stifling abusive lending. Early on, they adopt some of the strongest anti-predatory lending rules, and these rules were lauded for many years. And the rules prevented Fannie and Freddie from buying loans that contained certain types of abusive terms or that were the result of abusive practices. As we know, it's not all good news with Fannie and Freddie. Over time, subprime lenders began marketing their products to people who would have been better off with conforming loans. Conforming is a term that we use to describe the loans that meet Fannie and Freddie's criteria. So subprime lenders lured borrowers who could have gotten cheaper loans that could be sold to Fannie and Freddie into loans with teaser rates and adjustable rates that appeared more affordable, but in the long run were not. So as Fannie and Freddie continued to lose market share, they too relaxed their underwriting standards and began participating in the race to the bottom, which is where they are now. Fannie and Freddie did play a role in the subprime crisis by purchasing risky loans, but it was only after other lenders had flooded the market with these types of loans. But what's clear from this history is that Fannie's buying practices were not the impetus for the high-risk lending, and they only joined the fray late in the game. So at this point, you may be thinking this is a pretty depressing book, which it is in part, but there's hope. And where we get hopeful is when we look at the new financial reforms under the Dodd-Frank Wall Street Reform and Consumer Protection Act that passed in 2010. Just as an aside, in the category of be careful what you wish for, we really wanted to see some government reform of mortgage lending, and we finished the book last spring, and then Congress passed the law, so you know how we spent our summer. We had to spend the whole summer absorbing the new law and writing several new chapters to the book. The Dodd-Frank Act is grand in scale. It creates the Consumer Financial Protection Bureau, which is charged with regulating an array of credit products, including mortgages. The law requires that borrowers have the ability to repay any loans that they take out. It attempts to limit the mortgage confusopoly. Confusopoly is a term that Scott Adams of Dilbert fame coined, by simplifying products and improving the disclosures. And the law eliminates some of the incentives for brokers and lenders to push borrowers into higher priced products. Dodd-Frank also attempts to make securitization markets safer by creating mechanisms that allow investors to evaluate the risks associated with different financial instruments. The Act promises to eliminate bailouts. I think time will tell whether this is aspirational or an actual commitment. The law implements an early warning system that will set off alarms if systemically important institutions are at risk of failing. And it does attempt to regulate the credit default swaps, which ended up being somewhat toxic in this market. This is an area where I think Dodd-Frank doesn't go as far as it should, and I'm happy to talk about that a bit in the discussion period if people are interested. The Dodd-Frank Act is not a panacea. We still have some work to do. The future of Fannie Mae and Freddie Mac is still unknown, although we certainly know that it's not going to exist in the future as it did in the past, or either of them did in the past. Questions that have to be answered, and thankfully Raphael will have some wisdom in this area, is, what's the role of the government in financing loans in the future? What's the role of the government in regulating any entities that ultimately take on Fannie's and Freddie's tasks? Should guarantees on loans be from the government or through private guarantors or insurers? There are a lot of questions to be answered about interest rate risk. We certainly are all pretty committed to the 30-year mortgage, but that means somebody has to bear the risk of changes in the interest rate. Who should bear the risk of those changes? And what are different ways to allocate that risk in a way that will allow people access to credit? Should we be thinking about federal programs as being as countercyclical, where the government steps in with more support during bad times like now and retreats from the market more during good times? Can we avoid too big to fail when we recraft the functions of Fannie and Freddie? And then there are a lot of questions about home ownership. I think most people would agree that less home ownership is better than more home ownership at this moment in time, and given the recent experiences. But if we're going to move somewhat in that direction, then we have to make sure we have a good stock of rental housing, that people can get long-term leases, because one reason people buy is because they don't want to be have to move. And then we need to think about how we make homeownership more fair. For example, do we want to start allowing a mortgage interest deduction for people who don't itemize, so that it's not just affluent people who get that benefit? We need to adopt strategies that address sustaining homeownership, pre-purchase savings plans, so people aren't totally out on the edge when they go to buy a house. Emergency loan funds for low and moderate income borrowers who don't have money to tap when a boiler goes or something like that. Maybe we should be looking at insurance against interest rate changes for borrowers, where they could actually buy insurance so that they don't have to bear the risk of changes in interest rates. Other problems that we need to address is what's happened to our communities. We have communities that are littered with vacant homes that drive down property values and are often cover for unlawful activities. We also have social consequences we have to address. Families have been dislocated and separated. Children's educations have been disrupted. Some of you may have seen the reports that schools are now changing their curricula instead of being based on, it's going to be a 2-month unit on Egypt. They're doing it in like 2-week segments because there's such a change in the students in the classroom at any given time. People have lost important connections to their emotional communities, the people who give them support, who provide childcare when a kid gets sick at school, who are contacts for jobs. People are losing their connections to places for spiritual comfort. So all of those problems we're going to have to address. This is not the problems we're facing right now are not simply ones of how do we finance the housing market. My final thought is that people are mistaken when they describe the financial crisis as a perfect storm. A perfect storm suggests a rare confluence of events, and that is not what happened. The financial crisis began as a virus in neighborhoods like those that we saw in Cleveland and eventually infected the world economy. And to borrow from Camus, a virus never dies or disappears for good. It can lie dormant for years and years, and then, for the bane and enlightenment of men, rouse up its rats again. Thank you.
Thank you, Kathleen, for very provocative remarks. And you can tell from her remarks and the passion that she had behind it that she's been a tireless fighter on behalf of consumers and has a real interest in making sure that the markets work for people and that the markets give people opportunity and don't take opportunities away and get to more stability and opportunity and not less. And those are important things to keep in mind as we talk about these issues and as we think about what the next steps should be. Those principles about preserving opportunity, making sure people are more stable, and really are not victims and makes it very difficult for people to be victims is something that we should be seeking out. It's good to be here. Thank you, Reed, for the invitation, and it's good to see so many people here for this topic. It's one that I spend a lot of time thinking about these days, and it's good to know that I'm not by myself. I've really come to this from a number of places. So I do a lot of research on this. Reed mentioned that. Before I was here, I worked at the University of Southern California as a professor. That was one of the epicenters of a lot of the housing difficulties. And so I've seen it up close and personal. But Kathleen also has seen it up close and personal. And I always talk about Cleveland when I talk about housing markets because, when you're in LA, your reality is a little different. Not the way you guys are thinking, but it's its own economy. It's very powerful. It's a magnet for immigrants, so it has a dynamism to it. Cleveland is very different in that regard and has been for some time. And so the experiences of people in Cleveland and how they understand mortgage markets, how they understand access to capital, access to financial institutions is quite different, and it leads to a different reality. And Kathleen's characterization of this as a virus is actually quite interesting. I actually think there were multiple viruses going on because the dynamic in California was very different from the dynamic in a Cleveland inner city, and that ultimately they all came together to cause some significant challenges. What I thought I would do is talk a little bit about Kathleen's remarks and then take my own take on next steps. She went through a long list of questions. About 3/4 of them I had written down, so I'll get to skip over them. But there are a couple of things that I think I want to highlight as objectives and goals, and I'm hopeful that it will give you food for thought in terms of how you think about where the housing market is, what a next generation housing finance system should look like, and then what role we all have to play in terms of government versus the private sector versus the regulatory structure. Okay, so Kathleen asked a very good question. She started by asking who knew what, when, and what did they do about it? And then chronicled for a long time many instances of nothing being done. Is that a fair characterization? I was really pleased to see that she started back in 1994 because people have been talking about these issues for quite some time. And actually people have been talking about subprime and predatory lending for that long. My agency, the Department of Housing and Urban Development, along with the Treasury, issued a series of reports in 2000 talking about the rising incidence of high-cost lending or predatory lending in urban communities, and really was putting out a warning that ultimately wound up going unheeded. The regulators, they go to the banks, they see their activities. They started seeing these loans show up as well. And so the question is, well, why didn't they do anything? And when I talk about it, I think we have to think about the regulatory dynamic and the atmosphere around how government functions. It is, and I should say, in that conversation about bank subsidiaries, should they be regulated or not, I was there. I was actually a research economist at the board when they were having those conversations. And so it was, I got a lens on that was quite interesting. I guess what I would say is the reality has been for quite some time that there is a tremendous faith in the free market and that there is a tremendous faith in free-flowing capital, and that the government's role is to set up rules and then largely get out of the way. And in an environment where no one's losing money, no one really is observationally having problems at scale, it's a very hard argument to make that we should stop the train when seemingly everyone is doing better. And that was a very high hurdle that ultimately advocates were not able to overcome. Ned Gramlich, who was a board governor at the time, tried very hard, and he got some things put in terms of HOPA, but the broader agenda that he would have liked to have advanced just wasn't going to be possible in that kind of context because of that dynamic. And then there's a second piece which I think is really important, and I appreciated it's hard to stop something when everyone's making money argument. But there's a second argument which actually has emerged in this, which is that nobody really thought at a fundamental level that housing and housing finance had anything to do with systemic risk. Right? So this was a smaller market. When I talk about my background, I always talk about housing as the backwater. I go to an economist conference, I do housing, and people look for other people to talk to, right? And so it was never very interesting as a subject. And so the idea that we would go to great lengths to stop things in housing added a whole other layer to the difficulty in actually having aggressive regulatory activity in this regard. Well, it turns out we were wrong. Housing did have implications for systemic risk, and the free market doesn't always take us to very good places. And it's been a hard lesson. It's been a bitter pill to swallow. And I think it's been bitter for just about everybody, across the board. Now, the impacts haven't fallen evenly, and we can talk about that. But I think this has been really a sobering experience. Even Greenspan, the great free marketer, has said he was surprised that market discipline didn't stop us from getting to these extreme outcomes. Right? For him to actually say that, was actually, to me, breathtaking. Some would say it was a little late, but this has really led to a change in how we think about the free market. So now I want to talk a little bit about next steps. And when I'm in a lot of these conversations, the first question that people ask is, well, doesn't this mean that we have too much home ownership? We have to roll back the home ownership rate to a level that's more sustainable. And that means that we shouldn't do high LTV lending. We should roll back our government guarantees and price risk at much higher levels to sort of raise the barriers to reduce our risk exposure and reduce the ability of people to get into situations where they have to carry large levels of debt. I actually think that's the wrong question. And I think the question we should be asking is, how do we make sure that everyone is housed well? And for some people, that will be home ownership. For some people, it will be a different kind of home ownership, maybe in a smaller house or in a condo or some other cooperative situation. For others, it will be renting. And what do we need to put in place to get people, when they face the decision of how am I going to get housed next month, to make a good decision, one that's sustainable and one that will not leave them exposed to the risks that they were exposed to and ultimately succumbed to in this last episode. So that gets to questions about, what are the vehicles for deciding? How do we help people decide what the right decision is for them at a given time? It gets to questions of financial literacy. It gets to questions about building up a savings base and really organizing yourself financially in a way such that housing doesn't become a disproportionate burden or concern. For us at the governmental level, it really talks about an effective rebalancing of housing policy. So since 1920, every presidential administration, Republican, Democrat, Independent, whatever you want, has talked about home ownership as a goal, increasing the home ownership rate as a goal. Right? So this is not something where and actually it turns out there's almost no talking about rental policy. They don't even talk about renters, let alone have an articulated policy about them. That rebalancing, I think, is really important. If you look at the subsidies that the federal government gives to housing, 3/4 of them go to home ownership. Interestingly enough, most of that is through the tax code, so it's not through the housing agency, but it happens in other places. So this notion of housing support and home ownership support is really basically endemic to or basic to how we do housing policy and how we think about it. We think it's important to start to think about rebalancing that. Talking about rental markets, it turns out that a lot of rental markets don't work very well, either in terms of the provision of units, the financing of new construction, the ensuring that there's affordability. There are lots of problems and challenges with all of those. So I think that how do we get people well housed is an important question. And what that gets to now is some of the things that we've put in place. Dodd-Frank is very important. It's a very important first step. I would just really emphasize for you, this was a mammoth piece of legislation, extremely complex, and its implementation is going to be a challenge. So I was talking with a governor at the Federal Reserve last week. They have something like 350 regs that they're supposed to put in place in the next 2 years. Right? This is a huge undertaking, which really speaks to a couple of things. One, it was a big mess. Right? So we should be clear that a lot of things broke in a lot of places. It was not just one fail-safe that didn't work. Two, our system has become incredibly complex with integrated organizations, vertically integrated, horizontally integrated. There's a huge international component now. And the ability to put a comprehensive regulatory structure just requires a lot. And even with all that, Dodd-Frank doesn't get us all the way there. Right, so there's still broker regulation that needs to happen. There's securities regulation and reform that needs to happen. And Kathleen mentioned Fannie and Freddie, the GSEs. We actually don't talk about the reform as GSE reform, but rather as housing finance reform, because the GSEs interact with almost everyone else in housing finance. So once you change them, it's like if you have a puzzle and you change the shape of one piece, you got to change the shape of all the other ones. And so those are things that we need to worry about. Also important to talk about communities. I'm not going to go too much into that except to say that this crisis has made it clear how important place is and how things that happen in particular places in concentrations actually have material impacts for communities in ways that are really important. And we should, our administration has instituted and directed all of our agencies to understand how our policies are place-based policies because place matters. And how the place works will determine to a large extent how your policies work. And then the last thing, two other things. I think we have to think about the transition. So we talk a lot about Fannie and Freddie have to wind down. We're going to wind them down. And we are. But the question is what comes next? And that's where the conversation has to really begin apace. And the white paper was the first stab in that to lay some real markers and some boundaries around which we think some important conversations need to happen. But the conservatorship model is not long-term sustainable. We've got to get to something else. And that directly means that we're going to wind them down. And then the last thing I did want to say is we need our housing markets and our housing policy to give people choices, to allow them to take advantage of the richness of America, of communities and neighborhoods all over. Allow people to have access to neighborhoods of opportunity so that they can decide how their lives play out. And it's not a broker, it's not a regulator, it's not some bank president. It's the citizenry. And so our housing finance policy, our housing policy more generally, at the end of the day, that's where we've got to get to. And so I hope that our conversation never loses sight of the ultimate goal here, which is to really allow people to use housing as a platform, as a jumping off point for stability and opportunity so they can realize all that they have in terms of their hopes and dreams. So thank you very much, and we'll take questions.
Great, very helpful, thoughtful presentations. I actually had a bunch of questions ahead of time after reading the book, and now a number more after listening to the presentations, and I hope you do as well. So we'll have a mic that moves around. You can flag me down. I'll call on you. You tell me who you are and what the question is, and we can get a nice conversation going. But I did want to ask both of you almost to I do think Dodd-Frank is a tremendous opportunity. It also is going to be a challenge to implement. And almost, since you both identified some ideas about what the market and the opportunity should look like for families and communities going forward into the future, almost how can we use, or are there ways to use, the opportunity of implementing Dodd-Frank in re-regulating the market to also get us to a better place in housing policy? Is there ways that that process could be used productively?
Yes. So I think that's a good question, and this is an opportunity for us to really set up systems and lay out markers about what we believe good behavior and bad behavior is, good products and bad products, and put some boundaries on where the market is able and allowed to go. So I think the process, and this is a real opportunity for us to have a real explicit conversation about that, because markets innovate all the time, and we never get to say, stop, let's think about where we are, and maybe we don't like some things. The challenge, and one of the things that I know the folks in these conversations have been concerned about, is that markets do innovate and they evolve, and you want to have a regulatory system and a regulatory structure that is able to be nimble and respond to changes in the marketplace, so that as the new products emerge and as the new practices come up, they're able to evaluate them and quickly put them either in the box or outside the box. And I think that is one of the biggest challenges going forward, but I do think this is a tremendous opportunity.
The only thing I would add is one thing I really want to highlight that Raphael said is I think nimbleness is key, that we want to allow markets to innovate and expand and introduce new products and policies and all of that, but we need to not be quite so blind to what's going on and have the government being a careful watcher and intervene when's needed. And I think that what happened is the good times were rolling, and we just lost sight of that role of the government. Another thing is that I think that we need to be open to innovation in housing policy. And one of the things I'm a big fan of shared appreciation mortgages and products like that can help people to get into homes, have money at risk, have gains from maintaining the property and making it affordable. And that's just one of many different products out there that potentially could be helpful. And the other thing is I think we need to get out and talk to people who live in communities and ask them, what do you want? Do you want to rent or do you want to buy? What could you afford if you bought? To propose different models of home ownership to them and see what's appealing, because we need to have products that make sense, and one of the ways that they can make sense is by having them be set to satisfy the needs of the community. And we need to involve them in that conversation.
Yeah, I'm glad you mentioned that. I've been a big fan of the shared equity model as well, and I think it's a number of things that among many things that should be tried and explore what the potential is and how to develop some demand. The book really has a lot of analysis in it, but it also is a history of this very dynamic, impactful time. And you often show a series of opportunities for when regulators were kind of presented information, but they really just passed on taking action. And it really raises the issue for me about, what is the threshold of information, or what are some of the trigger points that we should expect to see some kind of action? The market didn't have discipline, but the regulators were looking on and really just as passive observers. And I don't know, after kind of developing this history and looking at all these examples, were there cases where people took action and what drove them and where they didn't? What do you think could have made a difference in your view of the history?
Yeah, so I think that the good and the bad news is that what happens in the regulatory arena is really driven by who's in the leadership. And if you look at the actions of different regulators, and by regulators here I'm talking about the bank regulators, SEC, FTC, any of the entities that would be involved in regulating this market, what happened really depended on who was in charge. So when Ellen Seidman was running OTS, she was pushing very hard for guidances that would allow, well, guidances are sort of advisory, but they let the entities that are regulated know what's okay and what's not okay to do. And so she was pushing very hard for some guidances that would require stricter underwriting of mortgage loans. But she lost that battle. Sheila Bair at the FDIC has tried hard, particularly when the foreclosure crisis started, to come up with some models for moving non-performing loans into performing loans through ideas of cram downs and her mod-in-a-box model, which ultimately is what HAMP was modeled on. So there were certainly regulators who did come out and try to do things. Ned Gramlich at the Fed was tireless in his efforts to both promote financial literacy and to put in some reforms in place through rulemaking. So, but the problem is that if there is a regulator who's paying attention and responding to the information that's coming in, that's great. Hopefully they won't overreach and we'll find the right balance. But if the regulators in charge decide that they really don't want to step into the market, then nothing will be done.
Yeah. Yeah, certainly heroes were hard to come by in the book, but you mentioned three, Ellen Sheila-Bear and Ned Gramlich. And Ellen Simon was our colleague here at the New America Foundation who's done great work. Okay, so give me some hands. We'll start way in the back and then come forward.
John Nelson with Wall Street Without Walls, and also a fan of Ellen Seidman, who's on my advisory board as well. My understanding is that the New Markets Tax Credit was passed on December 15th at about 2 o'clock in the afternoon, the last moments of the Clinton administration, and that Phil Graham from Texas attached an amendment saying that credit default swaps would not be considered insurance. So this was attached to the legislation. I may be a little bit wrong, but if you're regulatory mavens, I've been telling this story for a long time. So here Bill gets the bill and probably asks his buddies, what is the credit default swap? And they say, well, it's a good idea. It's some kind of financial innovation. And then another figure that you can probably correct me on is that I think credit default swaps went from about a couple of $1 trillion worth of coverage to something like $60 or $70 trillion worth of coverage in a matter of 7 or 8 years. So could you comment about that kind of regulatory juxtaposition and the fact that Glass-Steagall was also passed during Bill Clinton's administration? So it's not, and I'm very much a Democrat, but I think there's a lot of blame to go around.
Yeah, thank you.
Well, I have to tell you in the book, we take no prisoners. Yeah, I mean, the problems are not associated with one political party over another. I mean, I think, generally I would say that there were better decisions made under the Clinton administration, but I wouldn't say that all those decisions were beneficial to consumers. It was under the Clinton administration that HUD allowed Fannie and Freddie to fulfill some of their affordable housing goals by buying securities that were backed by subprime loans, and I think that conflicted with Fannie's and Freddie's own policies on not buying predatory loans. And I think that the deal that was struck with the new market tax credits, that wasn't about talking out of both sides of the Clinton administration's mouth. It was about political deal making, and you give me these new market I've heard that. I haven't actually, to tell you the truth, I haven't looked at it, but yeah. And that what's really important about that is credit default swaps serve two functions, or can serve two functions. They can function as insurance. So I'm carrying a risk. I don't want to carry the risk. I buy insurance so that if the risk I'm holding defaults, the insurer will kick in and I'll be compensated. So I get a lower return effectively, but it's guaranteed. But swaps also can be used as betting. So when they're being used as a bet, Raphael owns the risk, the reference instrument, and I bet with my daughter Eden that he's going to his holdings are going to go belly up, and so I buy insurance for my daughter, and she pays me if Raphael's holdings go belly up. So what does that mean? That means that we can bet all over the place. Each one of you can bet with another one, and we have this sort of daisy chain of potential liability that maybe that's the amount of bets is $10 trillion, and it's based on $1 million worth of bonds that Raphael is holding. So the notational amount can be very small, but the risk can be huge. Yep. So that's why that swaps market grew so much, because everybody's placing bets on each other, but because we don't use an exchange, and I don't want to get too technical here, but those bets aren't cleared through any type of a clearinghouse unless now under Dodd-Frank, unless they're standardized swaps. But most swaps are customized, and there are good reasons for swaps. So that's why that market grew so much. It was, it was an instrument, and people made money on it.
But the other piece was that no requirements to hold capital. Right. So you didn't actually have to have the money to be able to pay off if the bet went bad. And so that's how it really cascades very rapidly once it starts to go. And it wound up, this is one of the dangers of non-regulated markets.
Right, and it's why the industry did not want swaps to be deemed insurance, because if swaps are considered insurance, then they can be subject to state insurance regulation. And New York had tried hard to get swaps regulated as or classified as insurance. But that's a very powerful tool that the industry had, pushing that they were not insurance, because then that was a way to avoid having them regulated. And by regulation, we mean things like capital requirements. Insurance companies are subject to a fair amount of regulation in the United States.
Okay, right here.
Thank you. Scott Cooper with the American National Standards Institute. Mr. Bostic, you mentioned it's hard to get in front of the market when it's moving, and that's certainly the case. And I remember a quote, I think it was one of the Wall Street CEOs, I think it was Chuck Price, that said, when the music is playing, you have to dance. And how much due diligence you're doing while you're dancing, that may be more multitasking than people in Wall Street were willing to do. My question, though, for Mrs. Engel is you had enablers, though, that we're supposed to be looking at these things that sort of made this a lot easier to have the market move than it should have. In particular, I'm talking about the credit rating agencies. And it seems like they have gotten away pretty much whole cloth. Well, pretty much everybody else has at least had to go to Congress and it has taken a hit. They seem to have been able to hide behind their First Amendment rights, even though you look at every state, building code or bonding authority requiring that you have to have a certain rating, usually AAA or double A, before you can be rated.
So what do we do with them, in other words?
What do we do with them? Exactly. That's my question. And do you address that in your book?
Yeah. So I'm going to answer because I have to run out in a moment. But the rating agencies are not off the hook. I think every investor understands that the rating agencies failed tremendously in this exercise. And that has got to be one of the pieces when we talk about other things that are left to be done. How we deal with the rating agencies, there have been proposals that I've seen to remove the requirement that rating agencies have to sign off on things and really open it up to have performance drive a rating agency's engagement. So I'm not sure they're off the hook. I actually think that what rating agencies did, and there's a whole conversation we had, and I don't know if you have this in the book, but this might be something that a history needs to be written. Their function has changed over time. They used to only represent the buyers of securities. Then over time, they now represent issuers. And so in those two situations, their incentives are totally different. And as soon as you have issuer-represented credit ratings, now you're getting the most optimistic. And at the same time, because there's this requirement, due diligence basically went out the window. I call a lot of this era, the era of no due diligence, because at the end of the day, private agents are supposed to still look, and that just wasn't happening.
Yeah.
Can I follow up with
yes,
something?
Yes, please.
I just want to read you a quote. This is a former Moody's vice president in 1957. At that time, the rating agencies published ratings, and you subscribed to them. So it was not an issuer pays model. It was a model where you as an investor would buy the service, and then it switched to having the issuer pay for the rating, or as I like to say, have my students pay me to grade their papers, which of course they probably do through tuition, but anyway. So this is in 1957. He's saying, we obviously cannot ask payment for rating a bond. To do so would attach a price to the process, and we could not escape the charge that our ratings are for sale. Mm-hmm. So that was in 1957.
Right, and
of
that
course,
changed
the world
dramatically.
Changed.
Thank you very much. Raphael's going to turn to a pumpkin now and move on to his HUD duties, but thanks for your time. And we're going to continue to have a conversation here with questions, a lot more for Kathleen. So thank you. And yes.
Hey, I'm Kat Aaron with the Investigative Reporting Workshop. Kathleen, you talked about in Cleveland sort of seeing this focus in the late 90s on specific communities. I saw it in New York in the late 90s, a focus on low-income communities and communities of color for the targeting and marketing of subprime lending. What do you see as sort of emerging areas of contagion that are happening now in those communities that may ultimately spread to the broader public in the financial arena?
Thank you.
That is a great question and a hard one. And I think it's exactly the question we need to be asking right now. I think Dodd-Frank has done a very good job looking at mortgage markets, seeing where there were problems, where there were inefficiencies, and trying to come up with a new model for mortgage regulation. And it was kind of what I was getting to with my last quote about the virus, which is that we need to really be forward-looking right now, not just about financing, but where other problems are brewing. And I have a few that are on my list of things to do. That's the problem with this project. We started with this little question in 1999, and we always have a list of things to do. But one of them is credit scoring. I think that in some ways, like the credit rating agencies, the credit scoring companies have been operating fairly free of oversight, but we rely on their data all the time, right? We use FICO. I mean, I would bet most people in the United States think that FICO has the word federal in it somewhere. That has something to do with the government. I mean, even the government.
What is the F for?
Fair Isaac.
Fair.
Fair Isaac
right,
is the company. So we need to really look at credit scoring, how it's being used. Does it have a disparate impact on people of color, for example? And I know this is something that New America has I think, looked at some, is, should medical debt be treated the same way as credit card debt? And at this point on the credit scoring models, it is. Well, that's a problem. And there are concerns about the way people use credit based on income and race can affect their credit scores, even though they are still credit worthy. So that's one. Another thing is I'm very concerned about cross-selling and cross-marketing, and that is all about the information that lenders and marketers and sellers have on all of us, and they can use it in ways that potentially can be damaging, and that people don't understand how the information is being used. So I gave the example earlier of the brokers who would go down and see who had housing code violations, and then they would show up at people's doorsteps, and it would feel like just, what a great coincidence, or for some people, manna from heaven. Right when I need money, you're here. Well, some of these prepaid cards that are available track borrowers' purchases, and then they sell that information to other people. And I think that's particularly problematic when you look at cards that are issued by the refund and anticipation loan providers, where a company does your tax return and they give you a refund anticipation loan and they put it on a prepaid card, and then they track how you use that money. And some people go out and maybe pay off their credit card, and somebody else may be buying a flat screen TV. Well, that information is then valuable from a marketing perspective. So I'm concerned about the cross-selling and the prepaid cards. And then the last two things, I think we really need to look at mobile banking. What's happening with the banking through cell phones and other products like that, where what information is being shared by whom, what kind of regulatory control is there? Is this an FCC issue, an FTC issue? Is it a banking issue? So I think we really need to look hard at mobile banking. That's an area. And I'm not saying it needs to be, I'm not saying whether and how it should be regulated. I'm really responding to the question of where we should be looking. And the very last thing is data. We now have the Dodd-Frank Act, and as Raphael said, there are hundreds and hundreds of rulemakings that are going to have to come under the Act. But the problem is the federal government has stopped collecting data. Other than the Home Mortgage Disclosure Act, which is antiquated and I would say sloppy in terms of the reporting, we really don't have ways to systematically collect data. And so what we do is we buy it. We buy it from the private sector. And the private sector determines the fields. It determines who gets a license. The data can be hundreds and hundreds of thousands of dollars, and they determine how it can be used. And there's nothing wrong with that. The private sector has the right to do that, and I don't think they're doing anything illegal. But the problem is it really limits access to data. Well, the government needs information to write rules. And the lack of government collection of data means that the rules are going to be written based on the information that they get from the private sector.
Yeah, your comments reinforce for me that the landscape is changing for the financial services delivery for mortgages, for other financial products, and there's some potential there, but yet we need to be able to figure out how to regulate it with transparency, make sure the incentives are moving in the right direction. Yeah.
Hi, how are you? My name is Sylvia Randolph, and I'm from the National Organization for Women Foundation. And one of the questions in dealing with policy and dealing with the Dodd Act, and how do we, and I have so much going on in my head right now, dealing with this issue, one, trying to be a homeowner, two, trying to correct my credit, three, living in the inner city, four, being unemployed, five, so all of these things are on the table. And then how do you, or in a simple phrase or frame, if I was to walk out of here today and I'm sitting before a group of people who fall under all of those categories, knowing that policy is in place, government is trying to deal with these issues, you got the private sector trying to have their input in, you have loan modifications, you got all these things happening and going on, but I fall into this category. And I want to walk and talk with people who can assist me to get to that place where I can eventually have the ownership that I want. Summarizing for me, when I walk out of here, I can go to the person and say, this is what the New American Foundation is saying today, how addressing policy, Congress, addressing private sector, addressing the community. Summarize it for me just in a few words so I can leave out of here today and say, here's where I fall. These are all of the issues I fall under, and the American Foundation has said this for me today.
That's you, right?
Well, I'll speak for me. You can speak for yourself. How would you approach that?
Oh, I wanted you to go
Okay,
first.
well, I would say, I think it's in the book. I think that we need to look at policy mechanisms that, again, protect the consumer as a priority. Make the consumer a priority, and make sure that there are a set of principles that guide regulatory oversight and our guidance of the marketplace to make sure that products are appropriate, they're suitable for people, they're transparent, they're fair. And some of these principles, one of the reasons why people were excited about what happened with Dodd-Frank and getting it over the finish line, or these principles were elevated in the legislation. Now it's going to be messy, and we've got to figure out how to get it done. But there was a concept now, it's not just about disclosure, about, well, we're on page 30 of the legalese with your credit card statement or your mortgage that you're not going to read or understand. But it's about the basic deal that people would have access to. They'd understand it, and they would know that they would be have some basic protections back in the marketplace. I think that's really where we are in a lot of the policymaking discussion.
Yeah, and on an individual basis, just thinking about your hypothetical person, I think that people need to take advantage of programs that are in communities. A lot of communities have very strong adult ed programs on, how to get out of credit debt, how to, buy your home. All of those programs that are run through community centers, I think are pretty good, and at least they can help you connect with who's going to give you a fair deal and who's not. And I think a second thing is voice. We've forgotten how to give voice to what we believe in. Yeah, I really, it may be that when you call your senator or your representative, you just get checked off as for or against a bill, but those votes count. And when you get information from a source that you rely upon saying, call your senator, do it. It's a simple thing to do. You can do it by email. And then the third thing is learn. The great thing about the internet is that it's made us more information, more available more democratically. So to identify sources of information, go to New America Foundation, see what they're saying. Even if you're only looking at the 3-sentence blurb that tells you this is what's key about this bill or this policy or this housing goal, that's enough to start the process of being informed. So get information, get help on your own personal finances, and use your voice.
Thank you. Okay, we'll take a couple more questions here and then close up shop. So right here.
Thank you. I'm Kate McKee from the World Bank, and I wonder if you might comment on the phenomenon of regulatory capture. And then I have also a very different question for you, which is I work mainly with developing countries. And so what are the lessons that beleaguered regulators with not much capacity are who are trying to do something to protect their consumer in markets where access is extremely low, what do you think they should take away from this? And I guess I'm thinking particularly about your comment just now on disclosure, disclosure, product regulation. I mean, they have really different implications.
Yeah.
And then on the mobile banking, we actually published a piece on consumer protection regulation of mobile and branchless banking, and that might be a good area for discussion.
Yeah, Kate does wonderful work in this area.
Yeah, I saw your mobile banking report. It's on my desk, and it's great. Yeah, that's really good work. So, I don't want to go too far in talking about regulatory capture. I think that in the book we talk about it a great deal, and I think one of the goals of the CFPB is to avoid regulatory capture. I think the worst instance of regulatory capture leading up to the financial crisis was the charter battle between the OTS and OCC. So banks can have either what we think of as thrift charters, or they can have bank charters, and the agencies receive funds from the institutions that they regulate, and OCC and OTS got into something of a competitive relationship, trying to lure more banks to their charters, and it was really a race to the bottom, and we really saw it with OTS. So that's all about regulatory capture. In terms of developing countries, this is something that's near and dear to my heart, because I'm actually giving a talk at the International Association of Consumer Law Conference in July, and it's a plenary talk, so one of the things I'm going to focus on is what this all means internationally. And I think about it in three ways. One is I'm very worried about the abusive products that we've seen in the United States being the new export. Think about baby formula and things like that. And also concerned that when you look at a lot of the developing countries, many of the banks are owned by U.S. banks. They're not owned by local entities. Somebody told me that of the large banks in Mexico, there's only one that's owned by a Mexican firm. And if big banks, and I'm saying if because what I know about this is all anecdotal. I haven't done the kind of research that I did for the book because these are all emerging issues. But if, in fact, as some people have said, large U.S. banks are going into developing countries, buying up banks, and then putting a lot of pressure on the regulators in those countries to weaken their regulatory policies, it may be like baby formula and other things, Coca-Cola, cigarettes, things that we have exported that aren't necessarily good for other countries. And I don't, we just need to be thinking about that simply for the purpose of our country's reputation. Another thing is that we have a lot to learn from developing countries, because developing countries have had to innovate more than we have in terms of credit. And of course, everybody knows about microlending and things like that. But there are other projects that are going on in small segments of the world, and I really think we need to go out and learn about them and what's worked. The World Bank is a tremendous resource for identifying those programs. And actually mobile banking being a classic, right? Because mobile banking is used more, I think, outside the United States than it is at this point. Isn't that right, Kate? And remittances are going through mobile banking. So we have to learn, what are the experiences in these countries and what can we learn from them? And the last part of your question, and I think the hardest, or the last part that I want to answer, is about what do we do in those countries in terms of availability of credit and responsible credit. And that is a really tough question. I mean, I've worked some with folks in South Africa who have been working extremely hard just to even set up financing for car loans. We're still talking about interest rates of 25-30%. And in countries, I know it's been an issue in Peru where people don't have deeds to their land. So it makes it very difficult to give mortgages, because say, well, it was my uncle's and then he gave it to my sister, and there isn't even a registry system for land. I know in some countries what they're doing is they're making loans based on people's employment status. So if it's a country where a government job is a really cushy job where you have, a long job tenure and people aren't going to leave those jobs, then the job becomes the asset. And so the lending is based on the fact of having a government job. And it's meant that people, teachers and nurses in countries like Peru can now get a loan to buy a car and things like that. But in terms of the regulatory piece, I think it's one of the biggest challenges affecting the developing countries, and I honestly don't have any real good answers. Wish I did.
I think going forward, the challenge of responsible credit and responsible homeownership is really what we're trying to look at and define for our policymakers. I think we're going to stop there, and thank you for your comments today. Thank you for the book, Subprime Virus, and appreciate your time.
Thank you.